Common pools, okay, they are acceptable, i.e., well, 100, 1,000, 1 million investors, okay, they can contribute to one capital, which is a capital pool, which is a feature of conventional funds as well. This is very much acceptable in Islamic fund management as well. And similarly, the segregated portfolios, okay, or discretionary mandates, all these things are acceptable in Islamic fund management as well, as long as there is sufficient and complete segregation of different portfolios. And a number of jurisdictions, they cater for this one. In my view, the best one I have seen so far is Mauritius jurisdiction, where there is complete segregation of the individual portfolios. This is true in case of Luxembourg, even in case of Cayman umbrella structure and so on. And from Sharia viewpoint, this is important that if someone is investing in a segregated portfolio in the event of a bankruptcy of the overall structure, that should remain intact. This is an important Sharia requirement, even if this is not a legal requirement in certain legal jurisdictions. Next one, please. And of course, it is acceptable, okay, from Sharia viewpoint for a fund manager to offer an Islamic sub-fund as part of an overall conventional structure. And this is something which Amiri Capital would mention in the next presentation. The structure Amiri Capital has come up with is very interesting. It's basically plug and play structure. They have, of course, you don't have this conventional thing, but if even this was a conventional structure, you just rent technically one shell and start using it. This is very much acceptable in Islamic banking and finance. And as I said, as long as there is complete segregation, this is fine. The next one, please. Investment agency. Okay, I referred to this thing a couple of slides back when we refer to mudaraba and musharaka. Mudaraba is a contract. For those of you who are not aware of this terminology, this is a business contract between two parties, in which one party provides capital, money, and the other party manages it, okay, on the condition that the profit would be distributed between them in accordance with an agreed ratio. It could be 50-50, 90-10, 10-90, or whatever. And if loss occurs, the loss is borne by the party providing capital. Okay. Now this contract can be used for fund management as well. In practice, however, fund managers don't like this contract because there is no fixed management fee. It's all performance-based fee. Hence, although in Saudi and some other countries we find that there are some Islamic investment funds which use mudaraba as the investment agency contract between the investors and the fund managers, but predominantly this is actually wakala. Wakala means agency contract, which is used for Islamic fund management as an investment agency contract. This is precisely known as al-wakala bil istithmar, basically investment agency contract. This is a very flexible arrangement. Well, the investment manager, fund manager, can have a fixed fee. Ideally, that fee should be just a number. However, this is possible to have this fee as a percentage of a fixed number. So it could be 200,000 pounds, or it could be 2% of net asset value of the fund, okay, or 1%, or 50 basis points, whatever is commercially viable. On top of that, this is possible to have a performance related component as well. Here, the way we structure performance related component, it's not just 20% of the profit. That will not be possible from Sharia viewpoint. However, if we use wakala as an investment agency contract, this is possible to say that the return over and above, if a portfolio generates a return over and more than 7%, whatever is over and above 7%, that will go to the investment manager as a performance bonus. Right? So that is possible. So, and because of this flexibility of wakala contract, in about 98-99% cases, wakala is used as an investment agency contract. Important thing is that, well, the wakil or the investment agent, fund manager, must not offer capital guarantee. Again, okay, this is a characteristic of conventional fund management as well. And in most cases, we find this small print. The value of your investment can go up and down depending on the performance of the underlying asset. This means that the fund managers, they would not like to give a guaranteed rate of return on the investments they make. However, it is quite possible that the investment process generates a return which is in most cases, or which is always almost fixed return. So now if I come up with a murabaha based fund, and I know that I will be investing in assets which would generate 6% return. Okay, so in that case, in my offer document or memorandum and articles of association, I can mention that my investment process is expected to generate 6% return or 6% return net of fees or whatever. So, but as a matter of principle, an agent cannot guarantee a certain rate of return. And of course, as I said, okay, because there is no possibility of preference shares, hence one investor should not be preferred over another one, especially when it comes to the case of loss. Next one, please. Now, investments, okay, this is something which Richard would look into. Basically, what are the requirements for the investments, okay, how the investments should be made. About 15-20 years ago, this was a big issue in Islamic fund management industry, but now this is a very simple thing. We have a lot of information providers, Islamic financial information providers in the market, and they can guide you on what kind of investments are available from Sharia viewpoint. Okay, UMEX Securities, okay, well, the organizers of this seminar, they have come up with a wonderful product, okay, that allows you to pick and choose Islamic assets, even though without looking at them, because they have already been screened from Sharia viewpoint. Okay, and their partners, Amiri Capital, okay, they have developed a very sophisticated product, okay, which does exactly the same thing. Okay. Previously, many conventional fund managers would be hesitant to have an Islamic fund because they would not feel comfortable managing something in a Sharia compliant way because their own expertise in Sharia would be rather limited. But now, given that these third party providers are there, anyone can actually manage investment portfolios, funds in a Sharia compliant way with the help of these service providers. And as I said, okay, Richard, he's going to go through the details in the next presentation. An important thing, okay, the bottom line thing, okay, in case of Islamic fund management is that the money must be invested in Sharia compliant assets. It is not possible to raise money from Islamic investors and invest in assets which are actually not Sharia compliant. And as I said, okay, with the help of a number of service providers, this is very much possible. It's not only possible, it has become so easy. Next one, please. I think that's it. Okay, I've taken my 21 minutes, and if you want to get in touch with me, these are my details. And if we have some questions, probably we can take one or two.
Yeah, sure. Can you go over this? I didn't quite was not a big student here. You say you can under the share compliance structure, you can have management fees. Can you go over that again?
In case of mudaraba only, fixed management fee is not possible. Okay, this is basically if you invest with me, appointing me, I'm a fund manager as an investment agent based on the concept of mudaraba, then I should share the performance with you only. There would not be any fixed management fee. However, this contract in the context of Islamic fund management is not very popular. So only a handful of the Islamic investment funds where this contract has been used as an investment agency contract. The most popular one is wakala. In case of wakala, investment agency contract, both a fixed management fee and a performance related component is possible. So for example, if I am a wakil, I am an investment manager and my contract between with investors is based on wakala, I can charge them say 2% of the funds, okay, or on a going basis 2% of net asset value, okay, plus if there is certain threshold achieved, I can have some performance related bonus as well.
So it's just a book standard.
That's right. Because of this very close similarity of wakala with the conventional investment agency contract, this is the most popular contract used in Islamic fund management industry.
So why would a fund manager not go that way? Would sometimes investors reject this structure?
No, they would. This is why I said about 98% cases, this contract has been used by the fund managers to get the money from the investors. The other mudarba, that's used in very, very small number of funds. So this is the most popular contract even in Islamic fund management industry. In some cases, to give comfort to the investors, look, okay, if I don't perform, I'm not going to get any management fee. Okay, and as I said, okay, there are about 8 or 9 such funds where the fund managers, they don't get any fixed management fee, they share in the profits. Okay. And as I said, okay, out of about over 700 Islamic funds, total, well, the figure is about 900, only about 10 to 15 funds have mudarba as an investment agency contract. All others, okay, they are primarily wakala based.
So how does a wakala structure really differs from a book standard?
It's very close, as I said. Okay, this is very close to. One difference I have highlighted is that, well, the management, there is management fee component. Okay, there is this performance related bonus. Okay, you cannot say that I would like to have 20% of the profit, for example. It says, well, you can have the performance related bonus, the way it's structured, if there is this threshold achieved, say 7% return over and above that I will have as my performance, or 50% of that would be my performance bonus. Okay.
But that's mainstream.
This is what I'm saying.
Yeah. Trying to see what is.
In case of wakala based agency, okay, there are some very minor structuring differences. Otherwise, for all practical reasons, okay, this is that's pardon.
Minor.
This is one. Okay, for example, you cannot say that, well, 2% management fee and 20% of the profit. This is not possible. This is one difference.
You have a threshold.
That's right. You must have a threshold, and that threshold can be just say 1% or 2% or 3%. But the way we structure it must refer to a threshold. Otherwise, okay, this is not considered as an incentive bonus. This is one. The other one is that this must be structured as an investment agency. The simple wakala contract actually doesn't allow for this performance bonus. Right? The simple wakala would say that, oh, well, the wakil, the agent must be given a fixed fee only, right? No management, no performance related fee. right? But the way we structure it in the context of fund management